Hello and welcome to Fidelity Connects. I'm your host, Agnes Doherty. This month we're celebrating 7 years of Fidelity Connects and also 7 years of Fidelity Founders Class Fund. I'd really like to just take this opportunity to recognize the incredible team behind the scenes here at Fidelity Connects who do such a wonderful job of putting this show together every single day. We don't get to see them, but we really appreciate all of the great work that they do. And in a pretty full circle moment, Founders Fund portfolio manager Dan Kelley, he was actually the first guest on Fidelity Connects. And as we reflect on the past 7 years, we've seen a dynamic macro environment reshape the way investors think, act, and allocate. So how has the environment influenced the way that founder-led companies are identified? And what continues to drive long-term conviction? I'm really pleased today to be joined by portfolio managers Dan Kelley and Tom Williams for a look back and forward on how those shifts have impacted both the market and the fund. Welcome, Dan and Tom, and happy birthday, Founders Fund.
Thank you, Agnes. We're happy to be here.
Yeah, great to see you both. So Dan, we're obviously very familiar with you over the years. Tom, you are a newer face to Fidelity Canada. You are now a co-portfolio manager on the fund and will be taking over responsibilities at the end of September. But Dan, I just wanted to ask you first, why did we choose Tom to join you as the co-portfolio manager on the fund? Why is he the right person for the job?
Well, first and foremost, thanks, Agnes. I couldn't be happier to have Tom Williams here with me. If there's one person at Fidelity that is equally passionate about founder-led companies, it is definitely Tom Williams. He's been running a global founders mandate for over 7 years now. So looking at this same founders universe that I look at here, both here in the States and internationally, him and I talk regularly. We've worked together for many years. We have similar styles and overall investment process. So it's going to be a relatively seamless transition. Tom and I will be working closely together over the next 6 months. And I couldn't be more thrilled to be passing the baton to Tom because I think he's a great investor and someone I've really enjoyed working with. And I'm excited for the next 6 months and then ultimately to see him run with the next leg of growth for founders.
Tom, welcome to the show. It's nice to have you with us.
Thank you very much, Agnes. Good to be here.
Tell us a little bit more about your investment style and a little bit about your background as well.
Thank you. Well, as Dan said, we've known each other for a long time. We've worked together for more than a decade now, and we're both fascinated and excited about these founder companies, and both, I think, equally convinced of the merits of these businesses as an alpha-rich hunting ground, which I'm sure we'll discuss some of the reasons for a little bit later on. The interesting thing is that we both arrived at this conclusion independently, but at the same time, with Dan building the founders class that we're talking about today and me building the global founders strategy. My global founders mandate has a heavy emphasis on US companies, along with having some overseas holdings as well. And equally, founders class is US dominated, but has some good exposure to great businesses overseas. So I think it should be a relatively seamless transition here. And in terms of my investment approach, it's pretty straightforward. I'm looking for owner managed companies, so where the founder or the family owner of the business owns a significant stake in the company and has a board seat. I'm looking for high returns on capital employed. So ideally, we're looking at a business where it's taking in a dollar from shareholders and generating a profit of 20 to 25% on that. That's the sweet spot for me. And then perhaps most importantly, having low or no debt. So those are the three things: owner managed, high returns, and low or no debt.
And you had a pretty interesting background as well, I believe, before you became a Fidelity portfolio manager. Can you tell us a little bit more about that?
Yeah, well, I after university, I joined the British Army for about 4 years, and I like to joke that even though I was only there for 4 years, it's probably about 95% of my dinner party stories because it was a very learning rich environment. And I guess there are a couple of things which are tangentially related to investing. And the first, and you might be surprised to hear, is that British Army officers spend a lot of time in the library during the training phase. And there's an old adage from the War Studies Department at Sandhurst, which is where we do the officer training here in the UK, which says that it's better to shed sweat in the library than blood on the battlefield. But the extraordinary thing is that if you look back at military history, no one ever pays any attention to that advice. And it only ever seems to get heeded after the spilling of a lot of blood on the battlefield. And so if you take it a step further and you look at the causes of a lot of military catastrophes, they generally come down to a handful of similar factors. And chief amongst those are things like hubris, oversimplification, and an inability to be flexible or to deal with the emergence of new information. And so really, a lot of investing catastrophes are driven by the same things, both by the investors themselves and perhaps by the companies that they're investing in. So I'm going to considerable pains to try and identify when these things are happening and to try and keep an open mind to new developments. One example of that is if a company that has these very high returns that we talked about completes an acquisition which will really dilute those high returns, then that could be driven by hubris, or equally, it could be telegraphing that there's a tougher time ahead for the core business. So I want to keep an open mind and not get too wedded to things, and really just continually reassess the portfolio.
Yeah, that's really interesting.
And the other,
go ahead.
Very quickly, the other thing I'd mention is, I was in Iraq in 2006, leading these long-range desert patrols on the Iraq-Iran border, and it's quite a lonely time as an officer. And there's a certain loneliness to investing as well, I think, but particularly when things are going against you. So it's important to have a sort of calm and even temperament and keep a sense of perspective. And the Army was very useful for that.
Those are some really interesting parallels that you're able to draw on that experience and now bring it forward to your work as a PM. Dan, I wanted to move back to you and again say congratulations on Founder's birthday. Congratulations on such strong performance over the last 7 years. Maybe you can just reflect for a few minutes on what were some of the big decisions or key themes that really led to such strong numbers over the past few years.
Well, thank you, Agnes, and thank you all of Team Canada for all of the support. I have to give a special shout out to Will Danoff and Joel Tillinghast. This was their baby, their idea, and somehow I got tasked with implementing it. And after all these years, 7 years flies by, believe it or not, when you're in the thick of the markets. But after all these years, I couldn't be more confident in the mandate and what this mandate brings to the table. And I think what Will and Joel discovered, seeing the empirical data, has only been reinforced. So thank you, Will and Joel. I think, if I think back, Agnes, over the last 7 years, there were a few things I would highlight. First and foremost, I think people think of founder-led companies, newer economy companies, because the founder is involved bringing some sort of new idea or technology or product or service to the market. They think this is a tech or healthcare fund. I think it's important to distinguish, and I think the results demonstrate this is a diversified fund. And I think if I look back at performance, there's a few different segments that show when tech can be a huge driver of the fund and when other sectors can be a huge driver of the fund. And so I think back to the beginning of the pandemic, when we couldn't come into the office, the world was shut down. I rented a hotel room because I was so giddy at the opportunities that were presenting themselves to me in the founder universe in terms of long-term attractive growth stories being kind of marked on sale. And I rented a hotel room, and it felt like I was kind of, basically shooting fish in a barrel in terms of finding names that fit my process that were discounted relative to the long-term earnings growth potential. And I really kind of put more chips in the table on the acceleration of digitization, acceleration of movement to the cloud. So a lot of the tech-oriented landscape got turbo boosted during the pandemic. That drove a lot of the fund's returns for a few years. Fast forward to late 21, early 22, I was equally concerned that we had pulled forward some demand and those stocks had re-rated to levels that more than appreciated the long-term earnings growth trajectory. At the same time, it felt like the economy was overheating, the Fed was behind the curve, and I rotated into founder-led companies that were more cyclical. So think natural gas companies, and a lot of the energy landscape in particular. And I think that as I look back at the key drivers of performance, it's, I think, equal contribution from some of the more exciting technology, high growth names, and some of the more cyclical financials and energy names. So this fund kind of covers the gamut. And I think the last few years up until this year, which has been different, which I'm sure we'll talk about, I think it's been more steady as she goes. But I think those kinds of environments speak to this universe can be fruitful in a lot of different macro environments.
It's fair to say we're on a bit of a roller coaster right now when it comes to the markets. One day we're up significantly, the next day we're down significantly. So how are you interpreting all of this market volatility, and are you using it to your advantage, maybe to strengthen your portfolio? So Dan, I'll start off with you on that one.
Yes, I wish it was as easy as the emerging pandemic. This is a bit more of a countervailing headwinds and tailwinds. And the good news is, again, reinforcing this mandate, we're thinking long term. So we're thinking about earnings growth trajectories, durability of growth over 5, 6, 7 years. And as I think about the uncertainty that's being presented now with tariffs and slowing macro, a lot of those things are relatively temporary. And what you're going to see is a lot of attractive long-term opportunities present themselves where the correlations right now are really high, driven by macro, driven by trade war, and that's creating a lot of long-term opportunity for a fund like this, because I don't think for a lot of the companies I own in this fund, that Tom and I own in this fund, I think the earnings growth trajectory, my confidence in 27, 28 earnings power, free cash flow power is not changing much in the short term. Yet the stocks are getting kind of marked down, and that creates exciting opportunity. So I'll hand it over to Tom.
Yeah, Tom, what would you say sectors or industries that are looking quite attractive to you in this current market environment?
Yeah, the same sectors and industries as I was looking at probably before this particular market environment started. So I tend to be focused on companies that have very strong balance sheets, and you see this empirically actually across the founders universe, that they're much more likely to finance out of cash flow rather than debt, which makes a lot of sense, because if you had a big stake in a company, why would you imperil your personal fortune or your family fortune by loading too much gearing on the other side of the balance sheet? And that does give them this remarkable ability to endure during times like this, and really not just to weather the storm, but actually to take advantage of conditions like this, perhaps by making a move on a competitor, or opening up in a new market, or signing a lease when prices are more favorable. The other thing is that part of the high return on capital, one of the functions of that can be high gross margins. And so this is really important, because this environment is likely to be inflationary. So you want to own businesses where they have the ability to pass through perhaps quite sizable increases in cost. So high gross margins continue to be a focus. And also, these companies generate very high operating margins as well, despite spending more on R&D, which ordinarily should depress the operating margins. So it results in quite a resilient profile, I think, in this environment. I don't know what's going to happen. I think it's very hard to predict what's going to happen. The companies that we're talking to can't really form a view about what's going to happen. There's a lot of uncertainty around, but what they can control is the state of the balance sheet, and making some moves when times are right.
And so, Tom, you actually write a newsletter to your shareholders, which I actually had an opportunity to read this week, and find it was really fascinating. Maybe you can just sort of touch on some of the key themes that you addressed in that newsletter. It was sort of around, why you really think that investing in founder-led companies is such a compelling investment case, and some of the common characteristics that you see within these companies.
Yeah, well, thanks for taking a look at the letter. It was quite long, so you did well to get through it. But it seems to me that the more I look at these sorts of businesses, and I've been really studying family and founder-owned companies for about a decade now, that they just do things differently to your average professionally run, if we can call it that, business. In that, if you are managing the company in order to perhaps hand over your stake in it to your children or your children's children, then you just tend to think about the world quite differently. And so a lot of the behaviors that you see amongst professionally managed businesses, the use of words like optimizing, heavily gearing the balance sheet, they just don't happen actually by and large amongst a lot of the businesses that Dan and I are looking for. The tricky part is that a lot of these qualities are qualitative, and so it's hard to put them in a spreadsheet. And so it feels like one feels slightly fraudulent talking about them because it sounds a little bit airy, but actually they make a material difference to the culture of the firm, which is one of the most important things over the long term. A good example is decentralization, which is a really powerful force in business because you give people the latitude to be creative, and they tend to work very well. Tend to work much harder as a result of being given that leash. But it's a structure that duplicates cost because you have HR functions and finance and legal functions in each of your operating subsidiaries. But even so, despite having that, a number of companies that Dan and I are shareholders in have paradoxically higher operating margins despite this duplication of cost, and have grown much more strongly over a long period of time as a result. So these are the sorts of qualities that I'm really focused on. Maybe the things that don't fit easily into an Excel sheet, but can be very powerful drivers of compound returns.
The fund has a high exposure to the US, but it does have some flexibility to go outside of the US market. So maybe, Tom, I'll stick with you for this one, but can you maybe speak to any opportunities that you're seeing outside of the US marketplace?
Yes, and there are certainly some. I would say that by and large, returns on capital, which are the most important thing I would argue over the long term, do tend to be higher for US companies, which is why the majority of my portfolio in global founders is composed of US companies. But that said, you may find that there are market leaders residing in on other exchanges or headquartered in other countries, and equally, the world is a global place, and these are truly international businesses. So perhaps becomes increasingly irrelevant where the stock happens to be listed, as long as these are companies that conform to the economic criteria that we're looking for.
So, Dan, there's a lot of technology exposure in the portfolio. You did mention it's not just a technology fund, but given there is quite a high exposure to technology and there has been a lot of volatility within the sector, can you give us sort of your current thoughts on all things technology, AI? How are you feeling about that space?
Yeah, Agnes, I think it's a tricky time right now. I think we're coming off, I would say, one of the most exuberant times for AI and generative AI and what that platform shift could mean to the revenue run rates of some of these technology companies. And I think, unfortunately, that exuberance is meeting kind of cyclical concerns for the broader macro. And that's where I think there's going to be some dislocation over the coming months. There's been a little bit so far that we've tried to take advantage of for the shareholders of this fund, but not as much as I would have thought or hoped for in terms of me starting to get super excited and drooling at the opportunity. So I think it's just a function of time. I think there'll be some deceleration in revenue growth, and that's generally not a good thing when valuations are pretty stretched. But as Tom mentioned, these are some of the most defensive business models in terms of their balance sheets not being levered. They generate a tremendous amount of free cash flow. And I think the market tends to wake them up when they need to bring a little bit more capital discipline in the shorter term, or else they're going to be hit with a higher cost of capital via the share price declining. So I think we're just in some growing pains here. I'm equally excited about the long-term opportunity for generative AI, and I'm looking for companies that will benefit from that are getting caught up in this sell-off on macro concerns that will likely be short-lived for these companies.
If you were to look at opportunities outside of technology, can you maybe speak to some companies that you like outside of technology in the founder space?
Yeah, I think speaking to the diversified nature of this fund, there are a lot of exciting healthcare companies, whether it be in med tech, some of the interesting emerging medical equipment companies that are treating advanced stroke, for example, or some of the biopharma companies that are finally seeing some products make it through the pipeline and likely have a bigger opportunity. Alnylam are companies in the fund as of the last filing date that I think have underappreciated pipelines that will ultimately lead to more revenue opportunities. Alternatively, in the financials world, the alternative asset managers are likely to gain a lot of share on the other side of this period of dislocation. So I'm keeping an eye on those because I think they could be an attractive hunting ground in terms of gaining share from the wealth channel once we work through this period of uncertainty.
So Tom, if I could ask you just to maybe speak to some of the holdings in the fund, some of the top 10 holdings. So I see Berkshire's in there. Maybe you could comment on why you like Berkshire as a stock.
Yeah, well, what a fantastic combination to have these insurance subsidiaries that throw off billions of dollars of float that are then invested by the best investor in the world. So that's been an attractive place to be, I think. I guess just reflecting on what Dan said, it's amazing that a lot of investors are very excited about so-called emerging growth trends and new investment themes. But I would say that my focus has tended to be more on what can stay the same and continue to grow over time. And the reason for that is that I learned the hard way that very fast innovation and rapid change can actually be detrimental to investment performance because it tends to attract a lot of capital and a lot of competition, which ends up eroding returns on capital. So my focus is, I own some of the technology companies that Dan has spoken to that you've mentioned, but I'm also really intrigued by businesses where things are staying the same for very long periods of time, and they don't need to raise capital. Some examples of that: nobody leaves Stanford or Harvard thinking that they want to set up a uniform rental company or a salvage yard for crushed autos or a pest control business. And yet each of those companies that we have holdings in have generated returns on capital of 20 to 25% over very long periods of time and have been very attractive investments for shareholders. So it's amazing that the founder and family lens really opens up this very broad universe of companies that you've perhaps never heard of, but are doing boring jobs and making very high and attractive returns for shareholders as a result.
You mentioned earlier inflationary pressures could arise and potentially some slowing growth. How do you think of downside protection in your portfolio when we have these sort of macro headwinds?
Yeah, we look at something called down capture, which tells you the amount that the portfolio goes down in relation to the index, and we tend to screen quite well on that front from a historic perspective. So typically our down capture is in the high 80s, whereas our up capture is just above 100%. So we're keeping up when the market goes up, but winning by not losing is certainly a focus, and I think it's probably a function of these very good balance sheets that both Dan and I have mentioned, where when times are tough, you have a very well financed company that's gonna weather the storm. Whereas if you have a very highly leveraged business and you get a slight reduction in profitability, they can end up tripping covenants and having to issue equity very dilutively. So I think that is a very important feature of the ability to compound and endure over long periods of time.
Dan, would you say something similar? Like obviously a lot of volatility right now. What would cause you to sell a stock in the portfolio?
Yeah, first I would just echo what Tom said. I think generally speaking, the balance sheets provide some downside protection, but also the rate of growth tends to provide some downside protection because as everyone's focused on the short-term macro concerns, the companies we tend to own are compounding at high rates, and they just got cheaper, over the next 12 months, and that tends to be some downside protection. In terms of selling a stock, I think Tom and I would both say that if the thesis is called into question, that's kind of rule number one. He mentioned being flexible leading troops, on the battlefield. I do think you have to be flexible as a portfolio manager and not have thesis creep. And the good news about these funds is that we tend to not have a lot of turnover, but where the turnover does happen is when facts are changing, cards are flipping over, that's calling into question the underlying investment thesis, the founder's doing something that is counter to our original thesis conversations with him or her. And so we watch actions and make sure that they're reinforcing the underlying thesis. So thesis called into question, something going wrong, whether it be big acquisition, as Tom mentioned, allocating capital inappropriately, or something that's probably diversifying the business versus adding and enhancing the business. So those would be a few reasons, Agnes.
So as we sort of wrap up the conversation, I just wanted to pass it back to you both to ask what's sort of your final message to our viewers today as we celebrate 7 years and we look forward. There's some changes in the portfolio. What's sort of the key message that you want to leave with our viewers today?
Yeah, maybe I'll kick off. I'll just say after 7 years on this fund and on this mandate, I couldn't be more excited about the alpha generation opportunity by having a mandate that focuses on this universe. I think this universe has unique attributes that are highly correlated with outperformance over the long term. If you harness them, if you have a portfolio manager like Tom or myself that can identify the unique individuals that have a lot at stake, that's aligned with us as shareholders, that are committed to the long-term vision, and are bringing something new to the table that's likely to gain a lot of share. So I am excited for Tom to be kind of grabbing the baton over the next 6 months, and I think he has a long runway ahead of him of identifying these awesome opportunities.
Well, thanks, Dan, and I'm really delighted and excited to be part of the next chapter here. I don't know what the next 12 months holds for the economy, but equally I'd echo what you said, and investing in high quality companies that have owner operators at their helm feels like an instinctively good thing to do and a smart use of capital. Really, because you have people who are allocating capital like it's their own money, because it is their own money, which gives us the confidence that they'll be able to navigate whatever's coming down the track and really do so in the best interests of shareholders in the fund. So delighted to be here and enjoyed the conversation. Thank you very much.
Well, it was wonderful speaking with you both today. And Tom, we look forward to seeing you a lot more on the Fidelity Connect show. Dan, thank you for always being such a great partner. Appreciate your time.
Thank you, Agnes. Really appreciate it.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.